Namaste, Namaskar, and good evening. A warm welcome to each one of you. My name is Hariharan, and I head the Learning and Development Department at Axis Mutual Fund. I shall be the host for today's session on Growth and Beyond, a webinar on staying prepared for the market ups and downs. 10 months into the calendar year 2022, the global economy and the Indian economy seem to be poles apart. Various indicators suggest that globally, recession is knocking at the doors, especially in the West. The Fed's tighter monetary policy, higher interest rates, slowing global demand, along with the slowing China and geopolitics uncertainties, make the picture even bleaker. In such a pessimistic global environment, will the Indian markets wither the headwinds is the million-dollar question. Despite fears of global recession, the Indian domestic market has witnessed a purple patch, with the Sensex crossing the 60,000 mark and the Nifty clinching the important crucial mark of 18,000. We just finished the Diwali festivities, and this time around the expectation was that it is going to be a bumper Diwali. After 2 years of recession in the market due to COVID, the Confederation of All India Traders have estimated that this year's Diwali festival business figures could well top 1.5 lakh crores in the country. The GST numbers are out for the month of October, and it has clocked 1.52 lakh crores, which is the second highest collection since the rollout of the GST in 2017. India's GDP is expected to grow at about 6.8% according to the IMF. And according to IMF, India is the brightest spot in a dark horizon. This implies that amongst emerging economies, India's position appears to be more resilient to external headwinds. But is India really decoupled from the world? Maybe, maybe not. In a highly globalized world, can India be insulated from external shocks? A depreciating rupee will add to the current account deficit. Rising interest rates in the US will make it difficult for us to prevent the capital outflows from FIIs. What this could mean is that though India happens to be on a strong footing, the growth could get impacted because of the global slowdown. Fluctuating oil prices can also impact the economy. It could mean that the markets could be volatile, at least in the short term. To answer some of these questions, we have with us Anupam Tiwari, who is the fund manager at Axis Mutual Fund. I'd request Anupam to quickly give us a quick overview on the markets, both global and domestic, what to expect, and how should investors stay prepared for the various ups and downs in the market. With that, over to you, Anupam.
Thank you, Hari. Good evening, everyone. Thanks a lot for joining us today, sparing your time, your valuable time for us. So, I think almost all the negatives have been listed by Hari, which if anyone hears, then may decide very well to not to invest in equities market. But rest assured, stay calm. World is not going to come to an end. Things happen, negative things happen in the market. It's a cycle. So, and that is why we say that equity is essentially a long-term asset. Because in short term, there would be trouble, there would be problems that we have to endure. And eventually, as economy remains on its path of growth, given its structural strength that it has, things over a period of time sort out on its own. So to give you a perspective on what's happening around us in the country and outside the country, briefly, very briefly. So within the country, if you look at our second quarter numbers, they have been pretty much kind of unexpected lines. What broadly has been expected, certain sectors have delivered quite well, especially on the discretionary side as well as on the B2B side. And on certain sectors, there has been impact of inflation on demand and margins have been hit. But this was broadly expected, so nothing problematic on this. And now we have to see post-festive, as Hari mentioned, that festive season has been pretty good. How demand grows from here, I think there should not be too much of a problem. But of course, because market has run up and valuations are high, there has to be some kind of volatility also coupled with what's happening on the global side. So that's generally the broadly things on the ground on India side. If we look at some of the very positive signs, which are basically credit growth, which is doing very, very well across the board, across system, be it retail or be it on the corporate side, SME side, etc. So credit growth is good. And another good thing is that B2B demand is good. So that's very heartening. And as Hari also mentioned, the tax revenue has been good for the government. So there was this thought process that what happens if government is not able to maintain kind of fiscal mathematics that it has envisaged when it published its budget last year, but this year. But I think given the tax revenue, there should not be any problem on that. So that's on the domestic side. So things are okay. It's not a very great situation, I would say, given what the valuations are, but it's okay. There is no disaster that we see, at least in the domestic economy side. Now, coming to global situation, of course, China is in problem, both because of COVID as well as what's happening on the economy and the whole government sentiment. Whole sentiment caused because of government actions. We need to wait and watch and see what happens. Net, actually, India could be beneficiary of that. On the US front, because of interest rate hikes, etc., and inflation being high, emerging markets get impacted because essentially a higher interest rate demotivates people to invest in emerging market, and currency appreciates, and because of that, our currency depreciates. So, if you look at what has been the announcement from the Fed, is that they are comfortable, they are not in a hurry as of now, and they believe that the path is now in terms of overall inflation trajectory is under control, and over a period of time they would be able to bring inflation down, and that's a good thing because that gives some amount of certainty around it. The estimates of future hikes are lower than what current hikes have been, but of course there would be hikes. And because still the inflation impact is there, inflation on an absolute basis still remains high, but on an incremental delta basis, it is coming under control. So that's also augurs well for the Indian market. And as you would have also noticed that last year there was huge FI selling just because of this anticipation that Indian economy may get into a tailspin. And I think now that has played out, economy has not deteriorated, and hence we believe that even that panic selling or the extraordinary selling that was happening and creating problem for us will not be there in such a great extent. Of course, when FIs are buying, they at some point of time they will sell, but if that is kind of evens out, it is good. But otherwise, it's a problem if there is a massive selling, what we have seen in last year. So globally, things also look to be peaking out in terms of pain, especially on the Western Hemisphere. On China front, we have very little information exactly what goes around in that country, so can't say much about it. So that's broadly on the market. To sum up, things are okay. The results have been okay on expected lines, so nothing to worry about it. Now, coming to the point that how you can use one of our product to navigate in this difficult situation is basically we have a product which is quite conservative and it helps investor in certain ways, which I will explain. So we will go through a presentation and I will show you certain slides that will help you understand it better. Most of the investors who get into market, depending on, let's say, what the time situation is. So those who come in bull market, they always believe that market may continuously keep on going up. But generally that doesn't happen. Market has its own twists and turns, ups and downs. And that creates a lot of problem for some investors. One, psychologically, and also because heightened volatility impacts their returns and the overall portfolio performance. The most important point in market is the psychological impact that an investor has. You have to understand that in market, disciplined approach is the key factor for getting good returns. That's the paramount thing. Whatever you do, beyond the point knowledge doesn't help. Beyond the point you're doing too much of things, reading too much or reading market, doing a lot of effort doesn't help. What helps is whether you are a disciplined investor or not. And when I say discipline, you have to have a plan and you have to have a right time horizon for market to make money for you. Now, in short course of time in market, there are a lot of things that can impact market. For example, recently, last year we have seen FI inflows, outflows, central bank action that we have seen in US Fed, numbers, quarterly earnings that create sentiment up and down, global news and political events, etc. What we think that we are doing or what we want, the ideal situation is buy at lower level, the stock prices should go up, our market should go up, and we can sell it, wait for some time, then once again it should go down, we can buy in, this whole cycle so that we can continuously keep on making money. However, most of the time, and there might be people who would be actually following this, they would be capable, skilled, but broadly, most of the investors, generally if you look at market and you talk to so many investors, then we realize that what happens is people generally get into market in a Teji ka environment, in a bull market, and then they keep on buying and certainly market falls and then their experience goes for a toss and they stop investing. So this psychological problem of fear and greed plays out classically in every market cycle. It happens in every market cycle. So those who have sold now at bottom, then they will wait, once again market will go up and then they will come again, etc. That kind of thing plays out. And their overall CAGR or their return is very, very suboptimal. There is another problem of this situation is that when you experience this kind of pain point of volatility and you incur loss, तो portfolio में जो proper action लेना चाहिए, जो allocation of equity should be there, that doesn't work. So a lot of people under allocate to equity, and that is because of fear of loss. When they go through this cycle of profit and loss, and loss creates a lot of havoc in your mind. So then you don't allocate enough to the equity, and that is why your overall wealth creation doesn't happen. So this is a very important point that most of the investors don't understand. See, it is easy to create very high CAGR in your 5% or 10% of net worth. But the most important point is that let's say you have 100 rupees of total savings. Your objective should be to maximize return over a period of time on all the 100 rupees of savings, not just on 5 rupees, 10 rupees, 15 rupees. But what happens is that when you have volatility and you are afraid of it, you don't allocate enough to equities. And then over a long period of time, your CAGR on your complete, you may have very good CAGR on 5 rupees, 10 rupees, 15 rupees. But your overall CAGR on 100 rupees keeps on going down. And your wealth will not be created just by investing those 10, 15 rupees into good assets. It would be created if you have a proper plan, proper discipline, proper allocation of the complete 100 rupees into proper asset classes depending on your requirement. So that's a very, very important point that most of the investors sometimes overlook. Now, why we say that you should have a product like this, which is basically a dynamic asset allocation product, which keeps equity high or low depending on certain parameters. And broadly, when market goes up, equity keeps on going down. When market goes down, equity keeps on going up. That is how it works. That is why we call it a dynamic product or a balance advantage fund. So basically, the biggest problem in equities is psychological. So one is that at times when you hear a lot of noise from news, by your own discussion, etc., you get influenced by that because they have a vivid effect. So these days, US recession is talk of the town. If you recall those who are old in the market, that every time there would be a talk of the town. There would be something which would be very vivid and some discussion or other, some positive or negative. So जब इंडिया स्टोरी है तो भयंकर तेजी है, एंड व्हेन कुछ मंदी का स्टोरी है तो फिर वो वही चलता जा रहा है कि सब कुछ बंद हो जाएगा, राइट? सो दिस सब्जेक्टिविटी creates problem in your investment decision. and especially in your allocation. The more problem is in allocation because you are under allocating. The second thing is, so this model, which is based on certain objective parameters. So we use 3 parameters. I will explain it to you. Eliminates the subjectivity because there is some factor, some basic mathematical thing that ensures that at certain point of time, certain amount of equity has to be invested, which psychologically is very difficult to do on your own if you don't follow a method. So there is a proper method for it. That's most important benefit of these kind of products. Then dynamic behavior depending on the market scenario. So depending on market, it automatically changes its behavior. So for example, in an inexpensive and cheap market, it will behave like a normal equity fund because equity will be very high. In a reasonable market, it would be aggressive hybrid fund, let's say between 60, 70 or 75% of equity. In an expensive, highly valued market, it becomes a conservative hybrid fund. So equity goes down to 20, 25. So automatically, you don't have to bother on a certain objective parameters. It will decide the equity level and the behavior of the product will change. Protects downside by reducing drawdowns. One of the most important factor that you would have also noticed as an investor is that drawdowns impact you. When I'm saying drawdown, it means negative returns. So let's say you start from 100 and your NAV or your investment value reaches 200. And then suddenly there is a drawdown and it falls by 40%. So let's say it comes down to 120 rupees because 80 rupees is the drawdown or the fall. Though you are still 20 rupees in profit, but it will give you a lot of pain, psychological pain, that I have lost 80 rupees. उस loss का psychological value बहुत ज़्यादा है, and that impacts your decision making ability. So then you will say, no, let it go, recover, and then I will allocate more, etc. So because of having a conservative strategy, this protects your capital. There is another benefit of it. Now suppose you started with 100 and the fund reaches, let's say, 150, and as market keeps on going up, it starts reducing equity. So when market falls, the fall would be less. And at the same time, now let's say market falls by 20%. So 150 falls by 20%. So 30 rupees is lost and 120 should be there. But because equity would have gone down, here the fall would be less. So let's say it falls by 20 rupees. So you have now 130 rupees for next leg of journey. So now you will compound at 130 rupees. Your base has become bigger on which you compound. So a lot of people will think कि बस equity कम हो गया तो तेजी में participation कम हो जाएगा. Correct? And hence I may not participate enough in a bull market to create good return. But what those people miss is that if you compound at 100 rupees ka base at 20%, it will reach 120. But at 130 rupees, to earn 20 rupees, you need to compound at a lesser rate. So it is helping you on both sides. It's not just one-sided thing that cushioning downside protects it just provides the safety of capital. Over a long period of time, it actually helps you to build better wealth in a very, very comfortable manner. Then it removes need for the market timing, which of course is very, very clear from the nature of the product as it changes. And it avails equity taxation. So basically it helps you to have a lower taxation rate. So these are essentially one of the most important benefits for this product. So this product though looks conservative, but over a medium to long term, this is a very potent tool to create good wealth for you. So this is a basically open-ended dynamic asset allocation fund, and we used to call it Axis Dynamic Equity Fund, and now we have renamed it to Balance Advantage Fund. So what it does, what we do in this product is basically dynamic allocation. So we use valuation, risk parameter, and equity exposure based on that is dynamically decided. What it helps is a dynamic equity allocation enables lower equity exposure during high valuation, and thereby managing downside and reducing overall volatility. A lot of people don't appreciate how volatility impacts their mind and their decision making. So when you have a lower volatility product, you can actually allocate more money because you know कि इसमें downside कम है. there is an inherent capital protection kind of thing working in this. And this is a very, very tax efficient model. So here equity can move from 0 to 100% and fixed income can also move from 0 to 100%. So what we do, how we decide that how to allocate equity and what level of equity should be there in the portfolio. So basically we have an algorithm which is based on 3 factors, which is basically valuation, market volatility and market sentiment. We combine that and we have kind of a broad understanding of how these things have behaved over last 10, 15, 20 years. So we have a correlation or let's say regression model of that, and then accordingly we decide on the equity exposure. It's a proactive procedure. So we are very actively kind of changing the overall equity level in the portfolio depending on market conditions. The idea is that as market keeps on going up, becoming expensive, you reduce equity exposure, and as market becomes cheaper, you increase equity exposure. And at the same time, we keep in mind what is the market sentiment and how the volatility is behaving. The idea is that in a high volatile market, be slightly conservative, and in a positively trending market, mix sentiment. So trend is basically for us a measurement of sentiment. So mix sentiment as fundamentals, which is basically valuation. So we are not just relying purely on valuation. We are also matching market sentiment with valuation. If market sentiment is very high, even after higher valuation, we will keep slightly higher equity. So that is how that permutation combination works. So does this fund has a fixed rebalancing window? No, we can rebalance it as and when we want. And the arbitrage strategy basically helps you to manage the tax efficiency. So broadly, this is how the model looks like. So this is the market trend and this is the valuation. So as valuation keep on going low, so it's up but it's not high. Valuation keeps on going low and market trend is positive, we will remain, let's say, between 70 to 100%, and then we may moderate to 50 to 70 or go down significantly to 30 to 40 when market trend is unfavorable and valuations are high. So this is how broadly the model behaves. We will rarely go below 30. We are allowed, but model generally works with 30% minimum. You can say the minimum level remains between 30 to 40. So basically, how do we want to capture dynamism in our approach? Valuation and market trend, we combine them. So market valuation can be high, but can still keep moving higher. So as you know, when their sentiment is positive, valuation is not just a very, very cast in stone number that at this valuation, people will start selling, etc. And depending on incremental information, the earning estimates also change, the potential changes. And hence valuation keeps on moving in a band. So we combine them, the market sentiment, and then we use in the model to decide the overall equity allocation. It's important to identify the broad market trend, then react to short-term noise. Also, we don't look to rebalance for short-term market trends. So we don't do it on a daily weekly basis, because overdoing anything can cause problem. And hence we are not doing it on daily basis. In fact, we don't even do on weekly basis. Sometimes you will see that on month, the equity level has not changed at the end date. Sometime in between it changes. Market corrections are usually short and swift, whereas market rallies take longer to play out. So basically, if you look at history, average bear market lasts for 8 months and average bull market lasts for 34 months. So model aims to be quick and proactive in reducing equity exposure and steady while increasing exposure during market rallies. So in simple language, most of the time market will go up, sometime market will go down. So net result over long period of time is that market is up. But intermittently, there would be very high volatility. So we want to participate in the market. So we will not be too conservative in that sense. So that's what we want to say here. If you look at history for this model, this is broadly the exposure and participation looks like. So if you look at the period when market has fallen significantly, and this is the data for the model. So in 2010 and 11, that roughly 1 year period, so Nifty fell by 27.6%, model fell by 7%, and the participation was just 26%. So if you look at generally falling markets, the participation rate is quite low. But if you look at rising markets, so let's say 5 Feb 2010 to 14th October 2010, or in 13 to 15 or 16 to 18 period, the participation rate in upside is quite high, higher than the downside. So this is how we net think that we can create wealth for investors. How we now coming to the overall equity strategy of the product. So we follow a large cap allocation. We have in Axis, we have a philosophy of investing in quality stocks with sustainable growth potential. We follow the same philosophy here also. We are not a top-down investor. We are very much focused on bottom-up stock picking approach. So that's what we do here also. Current composition of market cap is basically almost close to 90% of large cap and balance 10% of mid and small cap, where mid caps are dominant. And our top 10 holding constitute 35.3% of our portfolio. This is broadly our portfolio. On the fixed income side, so basically it's an actively managed and diversified portfolio and mix of high quality corporate bonds and G-Secs. And our general target portfolio maturity is 2 to 4 years. If you look at the composition as of now, the corporate bonds are 8%, G-Sec and SDL is close to 10%, cash is 7%, and T-bills are around 6%. On the debt side, average maturity is 2.5 and modified duration is 1.95 years. YTM as of now is close to 7%. AAA is 92% and below AAA is 7.61%. So who should invest in this product? In my opinion, this product is suitable for everyone. Because as I said, investor makes generally 2-3 mistakes in equities. And that is why, so there are two types of investors who don't like equity because of volatility. कि बस loss हो जाएगा, हमको नहीं करना है, right? Then there are investors who are there, who invest in equities, but because of volatility, they are under investing. क्योंकि डर लगता है, you are fearful. And market में fear and greed is the most important psychological factor that you encounter. And that is the most important learning that you need to have to make money in a stock market. It's not too much of knowledge that you require. You require to control your fear as well as greed, right? So for those people who don't want to invest in market because they are afraid of volatility, this is an ideal product. Because as I have shown you, that the downside participation of this product is very, very low. Whereas the upside participation is quite high. So you have an automatic system to prevent significant loss of capital. And if you remain invested, let's say for 3, 4, 5 years, automatically, even if there are some losses, you will have a recovery of those losses and some decent returns. The second type of investor who are there in the market, but they are seeing the volatility because they are participating in the market, they are seeing the volatility, they are feeling it. So they are afraid and they are not investing enough in equities. If you give equities time, it will create wealth for you. If you just do it in a disciplined manner. And our mutual fund industry is a testimony to that across board for last 15, 20 years. That this industry has created wealth for investors. But you are under allocating. So if there is a portion of savings that you are just keeping in a assumption of that this is very safe, कि आपको लग रहा है आप उसको FD में रख रहे हैं या कहीं रख रहे हैं कि एकदम safe है, मेरे को इसमें volatility नहीं चाहिए. If you can spare it for 5 years or 7 years, 6 years, so then you can very well invest in this product. Because the volatility in these kind of products over let's say 4, 5 years, 6 year time frame goes down significantly. So loss of money on a 4, 5 year basis is a very, very remote kind of probability in this. So for both these type of investors, this product is very, very suitable. So basically, this is what we want to say here. Investor looking for a solution which dynamically adjusts equity exposure. If you are not too much into market, you just want one product which keeps on reducing and increasing equity depending on what is happening and what is logical, then this is the product for you. If you want to cushion downside, this is the product for you. This is for relatively conservative investors who either are not investing or not investing enough in the equity market. And please keep in mind that this is not a 1 year, 2 year, 3 year product. This is a 5 year plus product. Because it's a conservative strategy, it takes time for it to work a decent return for you. So this has been our historical trend for last 12 months. So broadly, equity has moved between 40% at lowest level to higher level of 61.7%. So I have discussed market outlook initially, so we can take it in Q&A. And these are basic facts about the load, etc. So I think, Hari, I am done from the presentation side. Now we can open it for Q&A.
Sure, thanks, Anupam. That was quite crisp and informative at the same time. We got lots of questions that have come up. I'll try and pick some of these questions. The first question is, Anupam, you talked about BAF as a product. What is it that BAF really offers, from an investor perspective, given a choice that an investor can individually invest in an equity fund and a debt fund versus investing in a BAF kind of product? So what is it that BAF really offers vis-a-vis investing in two different types of mutual funds?
Yes, so you are right, absolutely right. An informed investor can actually make the allocation decision on his own, which is theoretically absolutely perfect. But we have seen in our experience that it becomes it is a big challenge for every investor to become so much involved in the market and having their own proper decision-making discipline about investing. I think 99% of the people have overlooked their financial decisions. That is, at least last 15-20 years of my interaction with investor proves that people don't make timely right decisions. And that's the biggest problem. It's not about whether you got the highest return or not. People don't realize it. But you should get proper return on your complete net worth, complete saving. That is very, very important. So this product offers a very objective method to do that, where you can invest and forget, which is generally is the most challenging task. People forget to invest, people delay it, people get psychologically impacted because of events. So that this sort out that problem.
Okay, great. You talked about the model that is being followed at Axis. There's so many competitors who also offer similar kind of products. So if you could quickly touch upon the model once again, because there are a lot of questions that is pertaining to, are we using price to earning as one of the parameters, or are we using a different strategy? If you could quickly once again touch upon it.
Yeah, sure. So see, broadly we use three factors, that is valuation and trend and volatility. Because we believe, so for us, valuation is basically fundamental. And we look at price to earning, and we also look at dividend yield, etc., etc. We look 3-4 things. And volatility is basically our risk thing. How risky is the market? Because generally, when market is risky, volatility will go up. And when market is, let's say, not so risky, volatility will come down. So volatility for us is the indicator of risk. In a high volatile environment, we become slightly conservative just to prevent loss of capital. If you have capital, at some point of time, you can participate and make money out of it. But if you lose capital, even if market goes up, you don't have enough money to recover from that, right? So that's what the objective is, prevent loss of capital. And hence we keep a very, very important, very critical focus on volatility. And the third thing is market trend, which is basically sentiment. Market is not very scientific. It has its own mind and it is impacted by so many things happening around it. So you cannot have just a fundamental model. You have to kind of marry it with a market sentiment model also. And that is where we use trend. So broadly, these are three pillars that we use for this product. And then there are multiple permutation combinations that we use.
Sure, thanks. The next question is pertaining to, again, from a BAF perspective, whenever there's a market crash, we typically find that across, especially if there's a more generic kind of news which is going to impact the overall market, we find that across sectors, across industries, there's a trickle-down effect, and it sort of affects all of these sectors. And as you mentioned in your presentation, that sentiments play a very important role, emotions play a very important role, and that is where investors, especially when they see sharp corrections, do tend to panic, and therefore, how does sort of BAF help such kind of investors?
because it objectively decides equity allocation, they don't need to do anything. So on first stage, when market will fall, let's say there is a significant fall, because it has a conservative strategy, its fall would be less than market, right? Or its fall would be quite low. So I don't have that chart right now with me, but otherwise I would have shown you. If you analyze our model for last 20 years, only in 3 instances, it has actually given a 1-year negative return. And 3-year rolling return for the model is always positive. So it is 0 or plus. Right? 3-year is never negative. So, and in fact, for 3-year Nifty is actually sometime negative. On 5-year plus, Nifty is always positive and model is also always positive. So that's the beauty of this, that psychological impact of loss is very, very heavy on investors' mind. Not so much on what they have done, but more so on incremental equity allocation. So by cushioning the loss, by managing drawdowns at a lower level, this product helps them to keep calm and keep on investing. That is the most important utility of this product. And at the same time, you can very well participate in the market and create wealth for you.
Absolutely. It's a very interesting point that you mentioned, Anupam, that the model that you have tested, the back testing, suggests that over the 20-year period, you have done very well. Importantly, as you mentioned, on a 3-year basis, the rolling performance, there has been not a single instance of negative performance, which means that investors over the 3-year periods have not lost money in the Axis BAP. That's a very important point, especially for the investors who are looking at investing in mutual funds, first-time investors, a bit scary about equity investments. And I think this is where the fund sort of helps people to participate in mutual funds. This could be a fund for people who are willing to come for the first time. It could be for conservative investors as well. And Anupam did mention about the fact that from a 3-year perspective is what the investor should typically come from. I think that's a very valid and important point. The next question, Anupam, is that can BAF also be given for senior citizens, especially if somebody is dependent on a regular source of income today from a traditional kind of investment? Can BAF be a suitable replacement?
It can be, but then it has to be calibrated suitably. It may not be on a blanket basis. So one thing is that we don't have a monthly dividend kind of thing in this. So because we believe this is more of a wealth creation model, wealth creation product rather than generating monthly income. Because being equity higher at most of the time, it has its own volatility, and we don't want to create it as a monthly kind of product. So we have an annual kind of thing on the dividend side. Secondly, as I indicated, it's a 5-year plus product. So for senior citizens, the money that they can keep for slightly longer term, let's say 5-year, 4-year, 5-year plus, then it is suitable. Something that they need next year or maybe 6 months, etc. It may not be that great product, but for something that they can spare for 5 years, it's a very, very good product. As I said, our model has not seen less than 0% return or negative return on a 3-year rolling basis across board last, let's say, 18-20 years.
Great. I think I would want to also add a couple of points here on this question, Anupam, is that so for senior citizens and for people who are dependent on regular source of income, there's an option in mutual fund which is called as SWP, which is a systematic withdrawal plan, which is the exact opposite of a SIP. And the way SWP works is that one can, as Anupam said, we can calibrate what is it that I want as a monthly expense. And why this is very important in today's context is that, especially over the last few years, we have seen that interest rates on most of the traditional instruments have been coming down. But at the same time, the expenses of the senior citizens and people who are dependent on regular income have gone up because of inflation. So on one hand, inflation has made their expenses higher, but their earnings have come down over the last 10, 12 years. And that is why a lot of these investors today are willing to explore options beyond the traditional instrument. And I think that is where BAF kind of product and some of the other hybrid funds can also fit in by doing a systematic withdrawal plan. So one is you calibrate and say that if, for example, I want, say, 30,000 rupees of expenses every month, and I can also do a calibration in the sense that I can increase my withdrawals from the next year because next year my expenses will rise because of inflation. So I can factor in two things. One is I keep a standardized withdrawal, which could be say 30,000 every month going forward, or I can say that I want to increase it by some incremental percentage, maybe by 10% to take care of my additional expenses next year. And there are enough studies and data points that suggest that when you do a systematic withdrawal plan from a hybrid fund as compared to a traditional instrument, the withdrawals are in line with your expenses. Two very important point again, based on historical performance we have seen is that in a traditional investment, if I have invested 1 crore of rupees, at the end of the maturity, I get back that 1 crore. But in a hybrid kind of fund, there's a very high potential that your capital can also appreciate over periods of time, especially if you're going to stay invested for 5 years plus. I think from both that perspective, SWP with a hybrid fund sort of suits a lot of these traditional investors. The next question, Anupam, is so on the RBI front, there's a lot of this news. Again, today we had the off-cycle kind of RBI meet and the intervention to curb the inflation via increasing interest rate. What is it that you can expect going forward in the next few months?
I think there is expectation of at least, let's say, between 75 to 100 basis point hike. I think that is understood in the market broadly. This meeting is more to do with the requirement from the government that they have to explain if during certain period of time inflation remains above 4%, why they have not been able to control it. So they are going to prepare that explanation for that. I think this meeting is for that. On inflation front, I think there is no panic. It's now well understood and the path seems to be on expected lines. So it's not that RBI is panicking to control inflation, etc. I don't think that there should be any worry on that. And if you look at around the world, actually commodity prices are declining. So that will help kind of, except maybe crude, but the commodity prices are declining. And even in US, so US is more worried about not just on relatively commodity inflation, but more worried about wage inflation and asset price inflation. And we have seen in last 2 months or so that incrementally the real estate prices are declining. And at the same time, even the wage inflation is now kind of plateauing out. It's not, incremental delta is not increasing. So that's a good sign.
Okay. A slightly different question, since you talked about commodity. One question is on gold. And there's a question which says that gold is always considered as a hedge against inflation. And given the fact that today we are witnessing a multi-decade high inflation levels across most of the countries, but that is not sort of reflected in the gold performances, especially in the Indian context.
Yeah, I would say the only most apt hedge for inflation is only equities. There is nothing else. So yes, it has been, see, one has to understand there is a psychological reason for people to like gold, because especially in our country and some other country, because most of the countries have gone through a lot of very difficult phases in their life for generations, right? For example, our exposure to formal banking is started in 70s, not before that. So before that, people used to store their wealth only in the form of real estate or gold, because there was no other option. What you could have done, if you have made money or if you have wealth, either you could buy real estate or you could have bought gold. So people used to kind of balance it, some real estate, some gold. Now over a period of time, as globally and even in India, financialization of savings are happening. Hence that whole, and the new generation is also not too enthusiastic about gold, etc. So that propensity to buy gold and keep on storing it is going down. And generally, any asset class which is not keeping up with innovation, changes in the technology, etc., over a period of time, as the whole world becomes more tech intensive, etc., will lose its esteem. So that's what brought the reason is. Beyond the point, I don't understand gold. I'm a hardcore equity guy. So for me, equity is the best asset class.
Absolutely. Just to sort of add on to what Anupam said, I think one of the other reasons why, despite the fact that inflation has gone up, gold has not sort of kept pace is that the US dollar has kept on increasing, and that has become a much more attractive investment. Two, the yields on the US government bonds have also gone up. So again, you are getting a risk-free asset at a better price now, better rate, interest rate now, and that is why that was to some extent has also impacted the gold movement or the price of the gold market. So I think that also answers that bit. There's another question. In the current market, Anupam, generally we talk of equity investing from a long-term perspective, and we know that SIP is one of the best options to do it. Do you suggest investing in an Axis BAF or the BAF kind of product, or maybe generally a hybrid category fund by way of SIP route, or is lump sum a better option, especially in the current context?
See, in BAF, you can do lump sum because there is a formula which will automatically decrease equity. So SIP is basically for those people who don't have let's say lump sum cash flow, and they get monthly income, so they can invest monthly. It makes them more disciplined. It takes a lot of effort and thought process to cut a check of, let's say, 1 lakh rupee. But if you have to cut a check of 5,000 rupees a month, you generally tend to do it easily, much easier, right? And it doesn't impact too much you psychologically. So that is why how SIPs have helped people to create more wealth. People have not realized this, that slowly they have built so much wealth over a period of time. So SIP is a perfect tool, but if you have lump sum in this product, you can do lump sum because there is a formula which will reduce and increase equity over a period of time.
Great. So very valid point. There's a question on what are the various types of hybrid funds, which funds to choose, etc. So I'll quickly take that up, Anupam. So broadly, there are 7 categories of hybrid schemes as suggested by SEBI. I will quickly take you all through each one of them. The first one is a conservative hybrid fund. So as Anupam mentioned, hybrid fund typically will have multiple assets, at least 2 assets in the portfolio. So the conservative hybrid, as the name suggests, will invest in equity and debt, but because it is conservative, इसमें ज़्यादा proportion debt में होगा. So typically 75 to 90% will go into debt. 10 से 25% equity में जाएगा. Now, who is this suitable for? This is suitable for investors who are more conservative in nature, typically the traditional investors. But the advantage is that, just as we mentioned from a senior citizen perspective, BAF, for example, with SWP, the same concept applies here because you have 10 to 25% exposure to equities. There is always that chance that you will be able to generate a slightly better performance as compared to a traditional instrument and also keep pace with inflation. So that's an important point one should factor in. The second category is the equity savings fund. In this particular scheme, the fund manager has a choice to invest in, he has to invest rather in equities, arbitrage, and debt. The thing to be followed is that equity plus arbitrage has to be minimum 65%. And because it is 65%, आपको equity का taxation इसमें मिल जाता है. So that's one of the advantage of an equity savings fund, that despite the fact that you're investing in typically 3 assets, assuming arbitrage is also an asset, आपको फिर भी equity का taxation मिलता है. Investors who are coming to this fund should typically come with a 1 to 3 year kind of horizon for an equity savings fund. From a conservative hybrid fund, which I explained earlier, the investment time horizon should be minimum 1 year. The third category is the arbitrage fund itself. Very simple. It is basically working on the mechanism that there is mispricing between 2 different market segments, और उसी का फायदा वो उठाने की कोशिश करते हैं. This is suitable for investors who want to sort of quickly do a parking from a 3 to 6 months kind of perspective, and you again get the equity taxation. So that's the arbitrage category. We have aggressive hybrid, which is the other extreme of the hybrid. As the name suggests, इसमें equity ज़्यादा होगा, 65 to 80% will be equity exposure. The remaining 20 to 35% will be debt. Again, for people who want to create wealth from the long-term perspective, minimum time period of investing should be 5 years. They want to create wealth for some of the financial goals like education, retirement, etc., etc. Aggressive hybrid is one of the fund categories that they can definitely look at. Then there's a multi-asset allocation fund. As the name suggests, मल्टी एसेट में कम से कम 3 एसेट्स में फंड मैनेजर्स निवेश करेंगे, and typically one of the assets could be a commodity like a gold. So most funds will have a equity, debt and gold as the components in a multi-asset, and the criteria is that minimum 10% has to be invested in all the 3 assets. Advantage of a multi-asset again is that, again, there's one question that has come from the multi-asset perspective, so I will address that here. कि आप 3 assets में डालते हैं, and these are assets which typically tend to move differently from each other. Okay, and that is very important because जब आप ऐसे assets को जोड़ते हैं जो एक में एक से भिन्न हैं, अलग हैं, आपकी performances are not linear, and typically you get a better diversification and a risk which is lower as compared to a single asset investing. So that's one of the biggest advantage of multi-asset fund. Importantly, again, आपको wealth creation के लिए इस fund को आप use कर सकते हो. Minimum, again, 3 to 5 years of time horizon, one can look at multi-asset funds. Then the fund that we discussed today in detail is the dynamic asset allocation, which is more popularly called as the BAF, which is what Anupam took us through. He has already explained what is the advantage, what set of customers investors should look at investing. So the advantage is the flexibility to move between equity and debt based on market environment. Importantly, from an investor perspective, emotional decisions nahi honge because it's model driven. The software is going to tell us कि कितना exposure equity में जाना चाहिए, and therefore to a large extent we do away with emotions. And then there's a last category which is a balanced hybrid fund, which is typically about 40 to 60% equities, 40 to 60% debt. So these are broadly the 7 categories. The advantage of hybrid as a category is कि कोई भी तरीके का investor हो, conservative हो तो उसके लिए scheme है, aggressive है उसके लिए भी scheme है. So you get the entire spectrum of investors can look at investing in hybrid fund. So that is why, as Anupam said, BAF जैसे हर एक investor के लिए suitable हो सकता है. So you have so many categories of hybrid which can sort of take care of the various investor types and profiles. Okay. Coming back to you, Anupam. Okay, this question also I will take it up. Which hybrid fund is amongst equity savings fund, BAF, or aggressive hybrid is less volatile? You want to take this, Anupam? Which of the hybrid fund between equity savings, BAF, or aggressive hybrid will be less volatile?
I think over 3 to 5 year period, BAF would be the least volatile.
Okay. So yes, again, the reasons to it, as Anupam mentioned multiple times, the flexibility to move, and therefore, ensure that you're not too overexposed when the markets are heated up, is what we can sort of help investors, to generate a much better risk-adjusted performance. One last question, Anupam, since you also manage small caps, somebody wants to also understand it from the horse's mouth. What's your outlook on small cap going forward?
So if you have 7-8 year time perspective and you can leave money, so there is absolutely no worry on small caps. Short term, yes, valuations have gone up, तो थोड़ा concern है. Small caps are more volatile, तो जब भी globally कुछ ऊपर नीचे होता है उस पे ज़्यादा असर होता है. So that's one problem that you have to face. But if you have time, and especially if you want to consider our product, please give it time. And I would suggest 7-8 years at least, and you will make good money. Because as economy grows over a period of time, let's say if you look at a 10-year block, and I believe that next 10 years are going to be better than last 10 years. So whatever we have done from 2011-12 to 2022, let's say from 2022 to 2030-33 would be far better than that. That's my inherent belief. And in that environment, small caps are going to create good wealth. So no need to worry, but have a time frame, have a long-term time frame. That is the key for small caps because they are very volatile. And the only answer to volatility is time. There is nothing else that you can do.
Absolutely. So I think with that, Anupam, we have broadly covered most of the questions that have come across. Many of the questions were repetitive in nature, so I have tried my best to sort of consolidate them. And I hope all the investors who have joined in today have benefited from the webinar. And importantly, most of your queries and questions around market, around BAF as a category, and around managing volatility in the markets have been addressed. So we look forward to many more sessions in the future. Thanks once again, all of you, for taking time out, especially in the evening time on a Friday. And that clearly shows your inclination to understand your investment. That's very important. But knowledge, as Anupam repeatedly said, does play a limited role. It is more important that the emotions and the psychology of the investors typically results in wealth creation. And that is where the BAF kind of product exactly fits most of the investors' requirements. You don't have to take emotional decisions. Leave it to the software or the model to do it. So there's very less intervention, even from a fund manager perspective, in terms of equity exposure. It is purely decided by the model. Of course, the fund manager will have some amount of flexibility in terms of when to run the model. I think from that perspective, I think we can conclude today's session. Thanks, Anupam, once again for taking time out and addressing our investors and their queries. Investors, once again, thank you so much for your time. We look forward to your continued support in the future. Bye-bye.
Thank you, everyone. Thank you. Good evening.
Mutual
Bye.
fund investments are subject to market risks. Read all scheme-related documents carefully.